So we are live now and unscripted, coming to you from New York City, probably creating more value for my community of investors and subscribers and Facebook group members, probably than 1,000 suits and ties. I kid you not. But pretty interesting week in the stock market. We continued our volatile ride beginning of the week. We ended it well today, which kind of brings me to kind of my first talking point that I kind of want to address throughout the group. I had one of my comments on my newest video come through talking about why I tend to stray more toward a passive portfolio. And I'm working toward more passive. I don't have it just yet. Those of you guys who tuned into my portfolio review, I was glad to do that. I do those for my own reasons. I really do. I would really like to break down what I feel are a lot of social barriers to discussing finances. You know, if you end up going to a party or something, it's one of those discussions. It's kind of faux pas. It's not quite as worse as politics. You really want to fire somebody up, start talking politics with people, man. It's a big faux pas for me. I don't do it. But money's really kind of close behind, and I don't really understand why we're not more open to talking about, investing topics and things like that. And that's kind of why I do that, offer my portfolio, to you guys. But I got hit with a question through there, and it was talking about, why don't I go with single stock, why I'm not trying to beat the market. And put quite simply, it's because I don't think that that's possible. I don't. And what ends up happening, and here's my spiel on it, and right, wrong, or indifferent, if you can beat the market, great, go for it. What is problematic for new investors is when let's say they invest. And listen, beating the market to me is for 365 days. If the S&P 500 turns back, let's say 20%, and you're able to turn back 50%, all right? One of two things are going to happen. Either you're going to get overzealous and you can think that you can repeat that. And that's the key. That's really the key. And if you've made 50% in an up market where the S&P has returned back 20%, the problem is the following year, the S&P has a down year of negative 14%, and you end up overexposing and you end up down 30%, right? And that's usually the problem when people look at thinking that they can beat the stock market, okay? And I'm not saying that you can't do it, on a very isolated event. I believe I could do it. If I worked really, really hard every single day analyzing stock, which I do not have the time to do, I absolutely believe that I could trade in and out of enough stock to outpace the S&P 500. But could I do it consistently? That's the key. And when you're talking about the prospects of maybe beating the market, you have to look at where you're going to be down the road in the future. Are you going to look back over your life and you're going to say, look, I went passive. I took all the ups and I took all the downs, no matter what. I guaranteed that I was going to participate in the ups and I was going to participate in the downs, but I wasn't going to miss 1/2 of a smidgen of percent of rate of return in the market. And that's what I talk about by not trying to time the market. And I think a lot of new investors who are not analysts can't do it consistently. So why are we trying to do it? And that's why I try to pass that information to new investors coming into the stock market for the first time. They need to hear this validation from someone like myself who's telling you you can't consistently beat the market. So people sit back and they say, okay, Ryan, what am I supposed to do? I always thought that I was supposed to pick the perfect stock. No, you don't have to do that at all, right? You guys, the easiest stock to invest in right now is Apple stock. It blew the earnings out again. It proved all the analysts wrong. Of course, having Warren Buffett step in and take another large position, I think he took 75 million shares today in Apple, just goes to show how you can see the momentum going one way with the analyst reports, guys. They had a ton of downgrades just this week. And then you've got Warren Buffett, who calmly steps in and says, I want 75 million shares. Who, interestingly enough, they own the stock outright, but Berkshire Hathaway also has a huge holding. If I'm not mistaken, they're approaching 50% in Berkshire Hathaway for just holding Apple under Berkshire. So now they own the individual stock, and they also own it under the Berkshire holding as well. So it's really quite amazing to me. You can't always get caught up in all of the noise surrounding the stock market. Don't let that impact your decisions. Investing in an Apple stock is the easiest thing you could possibly do. It's easy money. It's easy money. And you don't have to try to trade in and out of it to try to somehow beat the market. You really don't. So we've got a lot of guys in the community. I just want to take this opportunity, honestly, to thank everyone who has kind of made this a weekly thing for me. I enjoy and look forward to my time with you guys. I wish I could actually see you because it's kind of weird talking to just my Apple computer, speak of the devil. But I do try to track I've got the flood of questions coming in to the right. So I do my very best to try to scan through that and hit everybody. I've got Average Joe. I've got Dave with me. So another channel creator, absolutely a shout out. Good evening to you, Dave. Nice to see you. I'm kind of interested to know how you guys are weathering this stock market. I'm not doing a whole lot of maneuvers right now. I did take a small position in Cisco and sold it today. That was a short position. I took a position in Intel outside my Roths. I sold that today. That was nice, made a quick profit. I did take some profits in Diageo. I'm trying to set up and appease one of my subscribers who says I have to get invested in Ferrari. And that's probably what I'm going to do. I'm going to take a 25 share position. I was hoping to get a little more opportunity to get into the stock at a little better stock price, but the thing has just run up quite handily. So I'll probably end up taking that. So I will get to my very first question. I've got 1-0. I hope everything is well. What's your take on AMD for the Roth IRA potential of long-term growth? I have 200 shares of AMD in Robinhood. Yeah, it's good. I think you'll be fine. Chips are out of favor right now. Micron Tech is one of my favorites, and Intel is my favorite. I do have a lot more technology exposure. I'm not invested in AMD, but I actually think that you can win with AMD. And I know a lot of you guys that subscribe and tune into my channel, the Independent Investor channel, also tune into Ryan Scribner's channel, who has a lot bigger channel, but I know does follow AMD directly. And I know he's got some specific reviews. He does a really, really good review of AMD, and I know he speaks highly of it. It's not really a stock that I cover. I have never owned AMD. I was actually kind of tempted today to take a short position in AMD. But my long position in the chip sector is Intel. I own 65 shares. I know you guys saw my portfolio review. You guys probably saw that I owned more than 65. I think I took a 50 share position outside. It was a short 2-day position. I actually traded in and out of it twice this week in my brokerage account. And I let the shares ride inside the Roth IRA to allow it to grow and compound. It's a long position in the Roth. It's a short position. As I try to accelerate a little bit of extra income in my brokerage account. Last year, I was successful in capping up my income by $10,000. So that was taxable income, but it's worth it. You take a little bit of trade here and there, and I'm very aggressive. When I'm in the green, I take profits, no doubt. I'm actually in the red on a couple of positions, both Amazon and Google. I'm fine. I'll hold them. If they don't cooperate, I'll hold the stupid stocks long term. So I win on either side of the house. And that's just how I approach that account. So I hope that answers you for your AMD. I would hold it 200 shares. It's fairly inexpensive, but it is priced correctly for a stock of its market cap. So just be kind of careful. You're probably playing with a little bit more of a growth stock there than a value stock, whereas Intel, it's going to get it done for you on the value side of the house. So I think you can win with AMD, certainly. That's really good. Buffett took it all. Yeah, I know. I tell you what, man, he proved a lot of people wrong. I love that, man. It's you really have. He wasn't even contrarian. I mean, he's investing in Apple, for crying out loud. You know what I mean? It's really one of my favorite companies. What's amazing is we will make up every excuse to beat up a company like Apple, and we'll make every excuse to accept the absurd behavior by Elon Musk with regard to Tesla. I just don't get it. I don't get it. I mean, without Elon Musk, I think that stock would be, I heard an analyst talk this week about without Elon Musk, I think Tesla would be worth close to nothing. I mean, he's really the genius behind, the company and the ingenuity. And I don't discredit that. But on the analyst call this week, he blew off an analyst pretty rudely. And the question was legit. Like, when are you going to start making money? When are you going to start burning through cash? They added an extra $1 billion to their debt. I don't get it. So, but I just find it funny how certain stocks in the stock market get a pass and others just, it's every excuse to beat them down, Yeah, Berkshire did sell out of IBM. They don't own it anymore. And that would be a stock that I would, if you're a long-term value investor and you're willing to sit on it through its, through whatever restructuring they're doing, that's great. But there's so many different cloud computing companies out there. Salesforce is one of them. There's another one. I don't remember the ticker symbol, but there's a really, really good one also that does business with Salesforce. But there's so many different technological plays out there. Geez Louise. I mean, I don't even know if I put IBM in my top 10 anymore. It does pay a huge dividend, but good grief. I just don't know if their legacy business is enough to carry them through for value investors. You're probably going to get a fairly good entry point here. But again, why invest in IBM at the expense of investing in, two big old school legacy blue chips in Cisco or Intel or Microsoft even? Microsoft is on fire, so I don't know. I think I would rather opt for a little bit more value because, IBM was a value play. It acts like a penny stock now. It's amazing how poorly that stock has performed over the last 5 years. It has not moved from around the 150, and right now it's in the low 140s. So it's really, really too bad. I'm sitting back taking notes. This is kind of an informal discussion. I certainly take this discussion where you guys want it. But give me specifics on what you guys are seeing in the stock market, any moves that you guys are making. That's what kind of helps kind of spur, my opinions on what you're doing. I've got Dave. He's got, I'm newly invested about 5 months ago, but going long on Texas Instruments, smart. See, I talk about those companies that, why opt for an IBM when you've got Texas Instruments, man? They just reported an enormous quarter. You're not going to go wrong with Texas Instruments. As a matter of fact, that's probably really high on my technology buy list. The unfortunate part for me is I'm already overweight technology. I'm sitting on about 23%. I probably reduced that just a little bit today with getting rid of the few shares of Cisco that I had and the few shares of Intel that I had, but just in the brokerage account, I still own 65 shares. But Texas Instruments is right up there. You cannot go wrong. Love what they have going in the microprocessor. Absolutely. Dave, thank you for that. Anybody who just saw what Dave posted, their Average Joe Investing, talking about Texas Instruments, man, you cannot get better dialogue like this on single stock exposure. I'm a big fan of Adobe systems as well. I really put them high on the list. But as I say all the time, you can really succeed in any stock at all that you invest in, and as long as you hold them in the correct account, you can win with a multitude of different portfolio makeups and a different, stock allocation, whatever it is you guys, see fit. You just got to be careful that you're not putting too much into single stock allocation, because I don't really care, what necessarily the stock is. Even the best stocks can really get hurt, especially if we start, on a downward trend. I mean, this week ended up nicely, which was a nice boost. But, one of my fundamental lessons, and you guys can kind of take this to heart, when you guys are referring to the stock market, it's never really as bad as you think that it is. But on the flip side, it's never really as good as you think it is either, So, today I had, a $3,000 upswing in the stock market, and, it is what it is. It's just a day in the stock market. I've had plenty of days, where I've been down multiple thousands of dollars, and that's just the way it is. The idea is that you keep your eye on the long-term prize. You stay invested. You don't lose your marbles when you've got the volatility, because the stock market has been nothing less than just absolutely volatile. And make no mistake about it, if you're involved in any fashion right now in the stock market, you are being tried, true, and tested. You really are. You're being tested because this volatility really is tough on new investors. But again, remember that every day that goes by, every week, week in and week out, you're becoming more and more seasoned, and you'll become more and more defensive in your ability to deal with these downturns in the stock market. So thank you, Average Joe, Texas Instruments, man. You guys are getting some good stock picks out of the deal. 1979 was the first one. I was throwing some dry humor at 1979. I asked him for some topics, and he left me hanging right before 9 o'clock. Ryan, I maxed out my Roth. What do I do now? Any suggestions? How should I continue? Awesome question. So what ends up happening when you end up maximizing your Roth contributions, and I want to know specifically 1979, if you maxed it out prior to the tax deadline of April 15th is the tax deadline, but you can contribute for 2017 up till April 17th, okay? So I need to make sure that you're doing 2017 contributions or 2018 contributions. All right, because if you did contribute under 2017, you've still got your 2018 contributions to do. But what ends up happening is if you max contributed your $5,500 and that $5,500 is in that account, that's in a money market account. All right, it's not invested at all. It's basically your holding account, for a lack of better terms. It's in an MM account. At least that's how it is on Merrill Edge. It will be held in that account and yield until you go in there and you tell that money where you want it to go. All right. So my suggestion to you, and this is a really difficult question without knowing a couple things, and I'm really, really aggressive on making sure that we ask, why are you investing? What is your age? And what is your risk tolerance? You have to set a goal. I have to know how old you are, and I have to know what risk tolerance. Now, this isn't for you, 1979, because I'm going to make a stab at this and say, you know, if I had it to do over again and I started max contributing, if you guys caught during my portfolio review, I said that if I had started investing when I was in my early 20s, that portfolio that I showed you guys would probably be 3 or 4 times what I showed you. I mean, there's no doubt in my mind, no doubt. So if you can get those dollars started in the right account and get it started in a passive ETF, there's nothing wrong with putting $2,500 starting position into the S&P 500 and S&P 500 ETF. And you guys know on this channel, I did a comparison between the ETF and the index funds. And I think ETF is the way to go. I do. I love the transparency. I love the fact that you can buy it during the market. I love the fact that there are no transaction fees. I love the freedom and flexibility that I can buy it in my brokerage. And the only ETFs that I buy is through Vanguard, right? So I can enjoy the same benefit that the Admiral share people will get on the index side of the house by investing in VOO, right? Same low expense ratio, right? With no minimum to buy. If you wanted to start VOO with $500, you could do that. I would like to see you take at least a 5-share minimum position and then set that minimum 5-share position up to reinvest your dividends. And this is something that I didn't know about until about a month ago. ETFs are eligible for dividend reinvestment within your retirement account. I did not know that, okay? But sure enough, I set it up and sure enough, it paid me the dividends and it rolled it right back into shares of stock for me. So that's a big benefit. It's one of those things to where you can put that on autopilot. You can put it on autopilot and let it work for you going forward. Now, with the remaining $2,000 that you've got that good baseline started. And don't underestimate the importance of going from zero to that first $2,500, okay? I'm assuming that you don't have any debt, and I'm assuming that you've got some level of cash savings built up. If you guys didn't catch on the portfolio review, I talked about the importance of always working hard to counterbalance the amount of cash that you have accessible and the amount of invested assets that you have exposed to the stock market. And you never want to find yourself over here with your pants down and the market takes a real haircut and it pulls you down without having a good buffer of investable cash over here or rainy day fund so you don't lose your marbles over here watching your investment capital. When it goes down, it's doing exactly what it's supposed to do. And then when it goes up, because eventually it will. It's doing its job when it goes up as well. But the trick is to identify when it's going down over here to take advantage of those opportunities where they present themselves, right? So I hope that answers your question, 1979. With the 2,000 additional dollars, you could look to take a position in 2 stocks. And right now I would look at Apple, and I would look at probably, Disney hasn't moved. Disney's one of my favorites. You could get a little more aggressive and take a position. I'm down 30% in Kraft Heinz right now. And what a beautiful, diversified 4% dividend payer in Kraft Heinz food. You could go with that. You could go with a Johnson & Johnson. You could probably go with a financial if you wanted. You could buy a big bank and JP Morgan. You could do something like that. But I'd like to see you keep it, to around either 1 or 2 stocks, maximum 3, because I don't want to see you water down the portfolio. Look to set a strong baseline. And if you set a baseline with 1 ETF and 2 single stocks, you're going from non-investor to investor in the correct way. Right? So awesome question. Thank you very much for asking. I hate that I don't have money for my investment. Hey, I tell you what, that's a really interesting statement. Stick with the group, because this group doesn't cost you anything, right? I'm on here for usually about an hour every Friday. Doesn't cost you a dime, but I would love to think that every little piece of information or every little bit of a comment maybe that I say is making you that much stronger mentally. And if you don't have money now, save that $10, save that $25. The reason why I can say that to you is because I used to be there. I've been in hawk with the IRS twice in my life, twice. Once for $5,500, the other one for $7,700. I dug myself out of hawk both times, no doubt about it. And you guys can do it too. And if you don't have any money to invest in the stock market, then start that savings. Start that savings. Start getting your mind conditioned to paying yourself first. It's very, very important. So I hear you, Julio. Stick with the community. The channel's not going anywhere. I'm not going anywhere. I love talking about this topic. I actually look forward to Friday nights with you guys. And every little bit that we bring up in the group will make you that much stronger for when you do get that first $1,000. I came out with a video about 8 months ago. It was called Investing Levels. And none of my videos have really caught on to YouTube. And I don't know if it's my problem with the search function. I don't know. But the investing levels, some of the very first videos, I was very raw on my delivery. I was very raw. I wasn't even doing thumbnails at that point. But I encourage you to go in there and look back in my old catalog. And I'm not trying to sell content to you guys. I don't really care. But every now and then I'll go back and I'll check some of my old content. And it's amazing how I'll watch myself and I'm very critical. But I'll at the end of it, the message, I'm like, hey, that's legit information. And one video I come out with investing levels is don't look at being disappointed that you can't invest in the stock market. Don't do that, okay? You need to look at what a realistic goal for yourself is. And if it's to save your first $500 or your first $1,000, then so be it. So be it. And don't stop until you reach that goal. And don't allow yourself to get misconstrued, right, on that goal by thinking about making the first $10,000. Why? Because you'll never make that first 500. Never. Because you're living in a pipe dream, right? So you've got to focus on those attainable, achievable, short-term goals. And then when you meet those goals, then you can start to bump it up a little bit. Get to that first 5,000. I've already talked to one investor in this group tonight who's just max contributed their Roth IRA for the first time. That is fantastic. But I can guarantee that $5,500 was not built up overnight. It was not. Right? So you got to start somewhere. And the funny thing about life is you get these funny little injections of cash, right? You get a raise at work. You get a new job, right? You switch jobs, right? You get a tax return, right? So you get a little injection of cash. And if you have those accounts ready to be started and start those accounts, starting the account costs you nothing, right? So you don't have to worry so much about not being an investor right now. What you can do is do those things now that are in your power to start for free. for free, listening to me, free of charge, right? If you can take away any sincerity from my message, which it's there for the taking, no doubt about it. I'm intense and passionate about this topic, and I believe I'm on the right track to let people know, because there are validations mathematically behind my self-directed program. It's that simple. But don't get overzealous about being disappointed, man. Don't do that to yourself. There's no reason. You've gotta be happy at first before you start investing, because I tell you what, once you do invest, it's not going to make you any happier. It's not going to make you any more spiritually, sound. It's not going to give you peace of mind. It's not. Investing will just give you what it is that is inherently in investing. That's it. You're going to watch your money go up, and you're going to watch it go down. And hopefully over time, we're able to extract a rate of return that is respectable. That's it. All right. So very good. I'm glad you brought that up. I'm going to go ahead and scan through these guys. I actually, my thoughts on Tesla, it was the same as last week. I'm not a big Tesla fan, man. I'm really not. I saw an SUV. I was out on Staten Island driving around this evening, and I saw one of the SUVs. I think it's ugly as sin. I'd never buy one. Never. I like the Model 3. I like it at $35,000, not $57,000. No way. I'll take a Tacoma TRD Pro. That's what I'll take for that kind of money, no doubt. Hell, I can buy a Tundra TRD Pro for that money. I don't need a car operated by a battery. I was down in Florida at a training last year sometime, and I walked by the charging station, and there was one Tesla there charging their car. I thought it was kind of funny because they were on the phone with the technical service trying to figure out what was going wrong with the Tesla. When I was done with dinner and I passed back by the charging station, people were waiting to charge their cars. Like they didn't have enough terminals to pull in and charge their Tesla. But that's all part of the gig. It's all part of the community. People who drive Teslas, it's more of a cult following than an actual practical matter. And I've heard the cars are quite nice. No doubt about it. I've heard they're quite nice. That's my thoughts on Tesla. So thanks for the question. I got Niella on here from Canada. I certainly want to address her question. Hi, Ryan. Can you recommend some monthly dividend paying stocks? What are your thoughts on dividends paying monthly versus quarterly? That's a good question. Most of mine pay quarterly. I don't think I have any stocks that pay a monthly dividend. So I really wouldn't want to miss comment on that. But as far as my dividend paying stocks, I just want to give you kind of my rules of the road. I would much rather take a 3% dividend out of a Procter & Gamble, which is probably giving you guys quite an entry point right now, guys. Procter & Gamble at 3%, than I would in some of the stocks where they start to get a little bit crazy with the dividend that they offer. And I know a lot of people, can chase dividends. There's dividends that are, north of 6 to 8%, depending on what sector you're looking at, can really signal a problem with the stock. Whereas a healthy dividend that's been responsibly increased over time, and they've got a history of those increases, and I talk about them all the time. Financials, we got Wells Fargo and JP Morgan. Certainly those are good ones. I've got Kraft Heinz Food, Procter & Gamble, General Mills, all selling at a severe discount. Comcast is one of those really interesting stocks that I'm looking at. Of course, Verizon, with Sprint and T-Mobile coming together. I just hope they improve my service because I'm with Sprint and they're not good. But the only one that I've heard is actually up to par on service is Verizon. But you're talking about a nice, healthy dividend with Verizon and a $200 billion company in market cap. So you're talking about a very healthy 5% dividend in Verizon, which I own. Also Chevron in the energy sector. I own Royal Dutch Shell and ExxonMobil. So you're talking about some very, very sound established stocks there. And depending on the amount that you're looking to invest, Niella, if you're looking at putting, let's say, 6 figures north of, right, you really need to look at the dividend at 3%, that's $3,000 a year. Is it worth putting $100,000 of capital to work for that $3,000? You may not want to look at it in that regard. If you're looking at $500,000 or above, or maybe $1 million or more in a dividend paying portfolio, now we're talking. Now that 3% could really be worth something, where you could be talking about $30,000 to $40,000 of income. So that could actually be a dividend income payer to you. So depending on the capital that we're working with, I can give you dividend names all day, and I'm going to be coming out with a video. I did a thumbnail on a portfolio, a dividend playbook for dividend payers, and I just need to shoot the video. That's the easy part. Honestly, I don't edit my videos, but the thumbnails, that's what really takes the time in my upload schedule. But I'm going to be coming out with a little bit more holistic answer for you with regard to the dividend payers that I would recommend. And I know you've got some really worthwhile stocks up there in Canada as well that you could entertain as options. And I remember you communicating some of those names to me, and those are very good options as well. But as far as your question specifically, as far as the quarterly and monthly dividend payout, I don't think any of mine are monthly. They're all quarterly. So I wish I could give you more on it. But let me get to Michael. How's Dad doing? Dad working it out, not having buyer's remorse over becoming a empowered, self-directed investor. Don't know if you've seen my post. Now I'm a proud owner of 30 shares in Apple at 168. That's got to feel good. No doubt. It's got to feel good. I don't know if it feels quite as good as me picking up Apple in the low 90s, but Apple continues to impress. Like I said, it's the easiest stock to justify buying. And I think you're going to find, I'd like to see you set that stock up for dividend reinvestment. I think we're going to perhaps have the potential of a super dividend paid for Apple stockholders. At least they're talking about 100 and 150 billion of repatriated dollars going right to shareholders. And whatever they end up doing, I'd like to see them put a lot of it in R&D. Now, that's just my opinion as a stockholder. I've got 65 shares of Apple. I'm a proud Apple stockholder, and I'm done selling the stock. It's a stock that I will never sell. Never. I'm not going to sell it, ever. If I end up living my entire life not ever taking any contributions from Apple, I would be satisfied with that posture, because I'll just give it to my kids. No problem. They can carry on the legacy. It's fine. It's not about the money for me. It's about the program. And I hope that resonates with you guys, because I mean it wholeheartedly. It's not about the dollars and cents. It's not. It's about putting a business plan in place and seeing it work. And it sounds like you've got a little piece of that with seeing that business plan validated today. It doesn't happen every day, no doubt. Okay. Stock market investing is a humbling place, man. It's like a war. You got to be careful. But congratulations on your purchase. I think you got a fantastic entry point. I mean, Buffett picked it up probably around that time. They don't disclose when Buffett picked up his 75 million shares, but he probably picked it up around that or even lower than that at an entry point. But 168 definitely gets it done, no doubt. Yeah, ADP is one of those, and Salesforce seems to be the other one. Yeah, you're correct, Dave. Thank you. There's actually another one. It was actually featured on Mad Money this week. I'm a big Jim Cramer fan. I think it's one of those very few investors that actually gets it. And if you've listened close to Jim Cramer over the last 10 years, Jim Cramer's the only one that has the courage to actually mention self-directed investing. He's the only one. And you got to listen for it, because if you don't listen for it and you're not privy to that term, it'll go in one ear and right out the other, because that's what happens when he mentions it. He doesn't mention it very often, but when he does, he mentions it as a very viable option for people. So pretty cool. Yeah, ADP is a good option as well. Paper gains and losses. Yeah, like I said, it's never as good as it seems, and it's really not ever as bad as it seems in the stock market. So as long as you can employ that, like on a day like today, I just kind of I mean, it was a great day in the stock market, no doubt. It made up for some, I'm still making up for some of my losses. I had a couple people hit me up and talk about offering the entry points into the stocks and how much I've made off of those positions. And I think it would be significantly complex to provide that to you guys. Because, for example, when Procter & Gamble ran all the way up into the 90s, I took a block position out of Procter & Gamble. So when it did return back to the low 70s, now I could have been wrong. There was no inkling at all. I was just up, 20%, 25% from the stock because my entry point was 65. So I decided to take $5,000 off the table. Now with that $5,000, I started new positions in stock. I kept about 15 shares of Procter & Gamble, but I didn't take quite a haircut when it adjusted back into the low 70s. I just thought I was overexposed. I guessed right, but I wanted to take some off the table because I was a winner. You know what I mean? And the decision to sell is a tough one, and you're going to be wrong as well. I just happened to be right on that one. I did the same thing with Pepsi. I took some money off of the table. I kept some shares, kept the dividend reinvestment going, but just took a block of pay dirt out of those stocks and started new positions into some stocks that I really, really wanted to start that I hadn't started yet. So that's what I did. I did the same thing with Pfizer, a couple others as well. JP Morgan ran up. I took profits from JP Morgan. And I think there's one other that I took a bulk of profit off the table. But you guys will find that when you get a little more seasoned on monitoring your accounts, you can kind of justify those moves. The only time that I say that you cannot sell a stock is when you're in the red. But when you're in the black and taking some profits, you will never, ever hear me fault that maneuver if that's what you if that's the move that you want to make. You're a self-directed investor. You can do whatever you want. I did 2018. Okay, cool. Thank you. Thank you for that. So if it's max contributed, there you go. You're good. I would just be kind of careful. Maybe, scaling into the market is probably a prudent move. Even if you wanted to take that block of position of 2,500 and put it into either VOO or VTI, either one, I would recommend the S&P 500. That's just me. If it's just you, if you are married and you have a spouse, or you end up getting married someday, certainly split it and do VTI in the other account, right? Because you're going to double your contribution value. That's what I do. That's exactly what I do. I own VOO. Actually, I own VTI, and my wife owns VOO. So that's the way I do it. And I don't think there's any reason to own both in the same account. All right. Connection keeps breaking up. Is that on your end or mine? It might be on mine, but I've had some pretty good live feeds the last couple weeks. It might be the kids on the other devices in the other room. I can go kick them off to help out with the feed. So I apologize for that. If it continues, please let me know, Dave, please. Alexander Torres. Hey, Ryan, what percentage should one keep in cash? And is it ever all right to not reinvest dividends and have it grow your cash? Yes, sure. It's a good problem to have, right? Not dividend reinvesting. The way I approach this is I just look at where I'm at in my life, and where anybody that I'm 40 years old, you guys know, but if you're in your 20s, your goal should be to build shares. Okay. Your goal should be to accumulate as many shares as you can, take advantage of dips, be aggressive on your dollar cost averaging program, reinvest those dividends, right? When you're young. The idea that I have is that if I'm ever in a position to turn the faucet off and allow those dividends to be paid to me as cash, right? That I can take those cash dividends out of the account tax-free as income. And I just think that that is a beautiful thing. So yes, you could do that to grow up the cash value within your account. Dividends are a beautiful thing, guys. And in a good dividend payer that has a history of paying dividends and paying back shareholders, there's nothing more guaranteed in the stock market than a dividend. They're beautiful. I love when the dividends pay me. You guys saw my stock portfolio, so you can only imagine how awesome it is when that pays me a dividend. It's amazing, and they're on different schedules. So just randomly, I'll get dividends thrown into the account. But I don't think there's a right or wrong answer to that. I don't. I just, if you kind of resonate with my approach in accumulating share base, right, when you're younger, and then my eventual goal of hopefully having those accumulated shares built up, and then stopping the dividend reinvestment and capital gains reinvestment program in the stock, and then just taking that as income. Hopefully I have enough in there to supplement, my other investments, right? My TSP account that I've got at work, et cetera, things like that. But I don't think there's any wrong answer to that. Now, to your first question, what percentage should one keep in cash? I'm not one to give you guys rules like that. I know a lot of people would come out and say, a financial planner, and you guys can cross-check me if you'd like. Go into a financial planner and tell them you have $10,000 and how much they would recommend that you keep on the sideline. I think you're going to be surprised at their answer, and it's probably going to be nothing. Okay? You're young. You can afford to make mistakes. You can afford to take the whole thing and invest it. Now, there is some merit to that. There really is. But the reason why I keep cash on the side is because I've made the mistake in my life of overexposing to the stock market, right? And then when I've needed money on the side, that money has not been there, and I will never make that mistake again. Now, that doesn't mean that you guys have to take my advice, right, and put 50% of your cash on the side. It doesn't mean that. It means that when you're younger, I would really look to have, start with 25%, start with a quarter of your money. It depends on how much tolerance you have to the market as well. Maybe your tolerance is kind of midline or low, right, to justify maybe taking and keeping 50% of your cash on the side, because that the first time that market takes a real haircut and your value of your assets goes down quick and you panic, it's going to be that 50% that is static that is going to give you peace of mind. And that means a lot to me. And I hope you guys resonate with this information, right? Because I've made this mistake in my past where I've overexposed to the stock market. And I don't want to see anybody get hurt. I want to see you enter into the stock market more defensive than offensive. Okay. So if you had $10,000 to invest and you took 2,500 of it and invested it into the stock market, I'm all about that, right? So in that particular instance, you got 75% on the side. That could be good for you, and it could be a prudent move here with the stock market at, just off of its all-time highs. It could be a prudent move to scale some of that into the stock market. Now, if you're talking about an amount that is $1,000, right, or $5,000, anything less than $10,000, I would like to see you continue to build up your cash reserves, especially if you've got $1,000 of cash on the side. I don't want to just see you take your last $1,000 and start investing it in the stock market. That's not prudent advice. It's not. It doesn't work, right? I want to see you continue to build and prove to yourself that you can pay yourself first. There's a lot of this is mental, and a lot of it is habit forming behavior, right? If you can pay yourself that $25 and you can prove to yourself that you can build up that cash reserve on the side, then you can prove to yourself that you can be an investor, right? And then you can get up to that first 2,500 and you can say, okay, I'm ready to enter the stock market. I've worked really, really hard on this 2,500. Let me take 1,500 and put it into the stock market. And as long as it makes sense to you, then I'm going to tell you that's the right answer. But what I'm not going to do is I'm not going to tell you the rule of investing says that you have to have 25% on the side and you have to take 75% and invest it. No way. I don't like to put up barriers to a self-directed investor. That's the very reason why we have the freedom to do what we want. And a lot of people are scared by the freedom And I'm here to exploit the benefits of the freedom of being a self-directed investor. If you don't want to invest 100% of your money, then don't do it. If 50% of your money, and what I do is I sit back and I say, you know, if I'm sitting on $1,000 and I really want to invest in the stock market, take half. Take half and invest that $500 into the stock market, right? My problem with investing less than $1,000 is it really doesn't get you a whole lot of share exposure into the stock market. It's going to be more of a mental victory for you because you've overcome that bridge of going from a non-investor to an investor. And there's value in that. There really is. So if you can justify taking those dollars and making that leap of faith, then it's worth the 500 to go ahead and start. But I'd really like to see you guys build up to that first $1,000 threshold at minimum, and then start to go for that 2,500, 5,000, 10,000 as I talk about on the investing levels, guys. Great question. Thank you very much. I'm going to scroll down through some of these questions. This is kind of, lots of great information on here. Thank you, Doug. I do the best I can. I really think it's better. I know it's kind of shooting from the hip, but you guys can ground truth all this information I talk about. It's legit. I do it every day. So it's really not that big of a problem for me to kind of offer my perspective on the stock market. It will, you know, evolve from week to week, but the fundamental premises, they're rock solid. They're rock solid. They really are. There, Dave's helping me out with one of the questions. Thank you, Dave. Appreciate, man. 1979, why would you buy Apple on the dip? If you hold long-term, 10 years or more, it doesn't matter what price you get it at now. A few dollars won't make a difference in 10 years from now. Just buy. That's some really solid advice from David. That's really solid. But, you know, with that said, it was interesting because going through 2017, did you guys notice if you paid any attention to the stock market, it went up every freaking day. It went up every freaking day. It was crazy. 2018, the volatility has actually provided you the opportunity to maybe pick up Apple on a dip. Okay. Now you're going to have a harder time picking up Apple now with Warren Buffett stepping in and taking his $75 million position. But you might. Okay. Because I still had analysts coming out today bagging on the stock, talking about iPhone is going to zero. I just don't understand that at all. Again, we can talk about a Tesla car that, yes, has demand, but they can't build enough product. Could you imagine how the analysts would lose their freaking mind if Apple couldn't come out with enough iPhones to satisfy the demand? They'd lose their cotton picking minds. You'd have sell ratings on the stock. You know what I mean? It's unbelievable. But it's a good point that you make on being a long-term investor. I do agree with you in theory and principle, but why not wait till Monday? You know, the market was up, 350 today, 400 points. On Monday, hell, it'll probably be down 400 points, and you get your opportunity on Monday. And I'm not joking. This volatility has been crazy. Up until today, the market hadn't been down, I think, 4 or 5 days straight. And today was the first relief rally. And that's really what I consider it to be, as a relief rally led by Apple. No doubt about it. Apple probably isn't going to dip anymore soon. If I had another 5,000, I'd buy more right now at a 184. Yeah. Well, yeah, I guess, if you guys are looking to make starting positions in Apple, I always talk to you guys about, I owned mutual funds for about 7 years before I bought my first single stock. So for you guys that are buying single stock earlier than I did, I applaud you. I will be the first to digitally pat you on the back, because it's gonna pay off. The single stock allocation will allow you to outpace the market. Okay, make no mistake about it. If I thought that passive investing was 100% the way, then I would be 100% passive investor. But I don't want to invest that way. That's just not the way my DNA works. It doesn't. I would like to be a 50% passive investor. And as I get a little bit older, I'm going to try to push that up to close to 75%. But when you're talking about larger dollar amounts, getting closer to retirement, I think 25% is legitimate when you're talking about hundreds of thousands of dollars of investment capital, right? I'm not looking to screw around with my kids' legacy. I'm not looking to do that, or my retirement for that matter. PG paying 3.96 right now. I've always said PG is a buy at 4%, maybe dip my toes next week. I think you're getting a great entry point. 70 was the entry point. It did go up with the broader market today. It was the first relief. I mean, consumer staples have just been absolutely beat to hell. It's like crazy. I mean, these are just incredibly good companies, and you have to find. You'll notice that the stock market from sector to sector will beat up one, and then it'll just switch to the next one, and for no good reason, it'll just beat up the sector for no real good reason. There was some reason for that with margin expansion in staples, but good grief. Back to Dave's point, if you were going to buy Procter & Gamble at $96, why wouldn't you want to buy it at $70 right here and take advantage of a fat dividend? I mean, $700 buys you 10 shares. So back to my first point, my first two stocks were Kraft Foods, that was before Kraft Heinz. That was my first stock, and AT&T. And I think I bought maybe 10 shares of each, maybe 10 share positions in either. So $300 each, I think at the time was what I paid. Right here, $700 buys you 10 shares of Procter & Gamble. I can't think of a better starting position in one of the biggest blue chip proven companies in the USA right now. Great starting position. I advocate the move. I really do. And I'm a long-term holder of Procter & Gamble. So Doug Whitaker hit me up. How do you feel about gas and oil? Bullish. Ugh. This is how I feel. This is how I feel about oil and gas right now. So I've got a lot of favorites. I own Royal Dutch Shell, Chevron, and ExxonMobil. As a value investor, that's what I own right now. I think you could win with 20 other names right now in oil and gas. If you guys paid attention, I do have a trading position on Seadrillers. CDRL is the ticker symbol. It's just come out of bankruptcy. It is trading for trading. I say trading because it's not an investment. It's a trade. At 30 cents a share. If anybody really wants a project, they can look into that. I bought a 5,000 share position just as an aggressive posture. When they come out of bankruptcy, I'm probably going to take a reverse split on it, and I'll probably end up with 50 shares of the stock at around $60 a share. But we'll see what happens. It just cleared way. It's done with its bankruptcy, and we'll know more in a couple months how that all shakes out for investors of Seadrillers. But it's UK's biggest driller, and they've got some of the most advanced fleet. And with an increase in oil prices, oil's approaching $80. I remember it at 20. If I had a crystal ball, which I felt like I did, I knew for a fact there's no way that oil was going to stay at $20. And I invested pretty heavy in oil at $20. You guys remember some of my marathon oil trades, things like that. I mean, at one point I was 36% exposed to marathon, and it was a little unnerving, but that's just the way of it. It ended up being very lucrative for me with marathon oil. I think marathon oil is still a buy here. I love Devon Energy on the liquefied natural gas side. Anything with Permian Basin exposure, I still like Viper trades under the ticker symbol Venom. That will pay you a nice big dividend. I believe that's over 6% right now. That's a high growth name. And then, of course, you've got ConocoPhillips. You've got BP. You've got Occidental Petroleum. Some of your major players. You've got Total Energy, which I've also recommended. Ton of different energy names. I could probably come out with a YouTube video on energy names, and that's exactly what I'll probably do, because I think energy is probably one of the most attractive sectors right now. But I do recommend a sector or a portfolio exposure of really not that much more than 9%. You guys saw that I was pretty close to 9%. So I kind of stick to those rules, right? So in a $10,000 portfolio, put $1,000 in oil. That's a good rule of thumb. Bought into CRZO. Nice. Congratulations. 200 shares. Congratulations. Niella, you're welcome. Awesome. Thanks for your question. I did the best I could. I hope that answered it for you. Canadian banks pay nice dividend. Yeah, exactly. That's actually, I try not to be too specific when I'm talking about somebody's portfolio because that information has been declared to me. But that's exactly what we were talking about. I'm addressing Scott S. Because Scott's talking about my Canadian asset reference there. I wish I knew more about it. All I've learned is people from Canada who talk and know the businesses that they do business up there with our neighbors to the north, no doubt. So I love it. So you're awesome, brother. Amen. Right on, man. I love it. Thank you. I'm still waiting for my $3 tip. I've went up every single week, man. The first week I got a $1 tip, and then I got a $2 tip last week. I'm waiting for my $3 tip. I don't even know how you guys do that, but I don't know. That makes my night. That is pretty cool. I don't need it after today. Today was a good day in the stock market. No doubt. It was a good one. It was a good one. We can afford to keep the lights on here, the Independent Investor Channel. We're not going anywhere. Would you buy more of Apple? That's a really good question. That's one of the best questions that I've got. Yes, in moderation. And I always like to tether Apple stock with another stock. If you bought Apple, I think it would be prudent because even though it is a value play, it is also a growth play. And Apple, for some stupid reason, is subject to negative reports. Okay, they're subject. An analyst will come out and they'll come out with a negative report or a downgrade, and the stock will suffer. The stocks that I feel like are kind of immune to that are Intel, Cisco, Oracle. Those three right there, I would love to see you maybe split your position. Take a 10-share position in Apple or a 5-share position, a starter position. 5-share, run you $900, right? $900 now after today. And then go ahead and buy a small position in either Intel, Oracle, or Cisco. And that'll kind of moderate and give you a nice mix of a good dividend pay and kind of protect your investment in Apple. But yes, Apple is always a buy. It really is. So hopefully that answers your question. I'm not buying Apple right now. I'm actually exercising the right to hold Apple right now. I am not accumulating shares of Apple right now. I am allowing my investment to work. All right. So thank you, Alan, for that question. Very, very good question. But I think it goes to 220. So if that answers your question, I mean, right here at what did it? I don't even know what the stock settled at. And I had to take off. I didn't get to watch the end of the market today, but it was approaching 185. It had a fantastic day today. I don't know where it settled out at. I don't know. But here in the low 180s, I mean, your price to earnings ratio is still in the low teens. You don't get any better than that. You don't. I mean, you're having to pay more of a premium for Intel. So, and the reason I mentioned Comcast, look at the forward multiple on Comcast. It's amazing. I think it's trading at 7 times right now, which is basically free. I've added to my position in Comcast. I'm now up to 150 shares of Comcast, and Comcast has got close to a 3%, maybe a 2.5% dividend, if I'm remembering correctly. But Comcast is another good play right now. All right. Dad's doing good. Got his portfolio worked out, and I'm planning buys for next week. Had to sell out of about 10 ETFs. Oh my God. It sounds like they did him wrong, man. That's really too bad. But, you know, I don't think it's ever too late to right the ship. I don't. No way. I want to get your dad invested correctly, man. And just make sure that he resonates with the changes that are being made to his longstanding portfolio. Make sure he embraces the idea of kind of going out on an island a little bit. You know, you don't have that validation of being like, I'm with a financial planner. You know, in my world, it doesn't mean squat. Okay. It doesn't mean squat. It's a false sense of security. Okay. So don't think for a second that I'll sit here and advocate for that type of behavior, because that's a watered down portfolio, and it pisses me off. I told you a couple of weeks ago, it pisses me off for your dad. Like, I'm mad for him. You know what I mean? But I've been there and I've done that. So I can be mad for your dad, and I can have validation as to why I'm mad. But clean it up for him, Michael. No doubt about it. Clean it up. There's no doubt. The information, man, I'm passing to you. I'm not charging you a dime for it. It'll be worth so much more in the future. And if nothing else, man, at least you take some peace of mind knowing that you're invested correctly and you're not subject to some idiot in a tie that dresses really nice. Remember me? You guys get this information, and I have bare feet for a reason. I do it to prove a point. Prove a point. You don't need to have a suit and tie to provide credible information to people. You don't. And that's what people expect. And I want to blow through those barriers, man. Those social norms, I just don't understand. They drive me up the wall. They really do. They irritate me, as you can tell. So it's good to have your dad on board, man. It really is. It's very cool. Profits giddy up. Yeah, no doubt, man. No doubt. Freaking A. Those financial planners, man, they think that because we buy Apple, it's some like different hybrid version of Apple. Nope, it's the same shares that they'll buy you or recommend or talk you off of so that they can sell you their mutual fund that makes them 1.67% of an expense. And then they get a kickback for selling you that mutual fund. And you're like, whoa, hold on a second, man. It's a 3-star rated fund. Why can't I have this 5-star rated fund over here? And they'll give you some BS about, it's probably projected to go up over the next 2 years, So I really want to have you in this because I really think it's going to go up, And it's like, it's all BS, man. It's all BS. So how long have you been investing? I got into my first mutual fund when I was probably 18 years old, and I did everything wrong. I grew up in the country, so I had somebody come out who was actually affiliated with the church of all things, came out, sat with mom and dad. I actually was invited to sit down because I've been interested in finances my whole life. So I was invited to sit down, and that's what kind of got me thinking, my first job was a landscaping job at 14 years old. So I was picking weeds and laying sod, was when I was, 12, 13, 14. I mean, it was my baseball coach. That was my start. I was picking weeds, man, out of the Nandinas. That's how I started. And I've been working ever since. So my investing career started when I was about 18, 19 years old. The savings started early, the piggy bank philosophy. So as quick as you can get that mental conditioning of finding value in dropping those coins into a savings, it's more about that. It's more about that. It's all about the mental piece. And I got with my first broker after I was done commercial fishing. I took my last $10,000 that I made up in Alaska. I think it was Alaska. It might have been Los Angeles. I'm not really sure. But I said, if I was going to do anything with my commercial fishing career, I took my first $10,000 or my last $10,000 check, and I took it into a broker, financial planner at the time was Smith Barney, and screwed me over big time. I should make a YouTube video. Took the $10,000 and put it into a money market account. Never invested the money. Never invested it. I went back 3 months later, and they did back pay me the money I would have made had I been invested in the stocks that we talked about investing or the mutual funds. And what they ended up doing was actually going ahead and investing it after I was pissed off, right? They invested the money. They invested me in Class C shares. So that led me to transition to my third broker, which was Edward Jones. I was with Edward Jones for a long time. And from an educational standpoint, I still consider the two financial planners that I had friends with them. I'd love to talk to them again because they're really nice. I still have some business. My kids' 529s are with Edward Jones still. And if I called him tomorrow, I enjoy talking to the guy. It's just that when I parted ways after 7 years with Edward Jones, what allowed me to sever the ties with the financial planner is when I got the 1099 dividend and interest statement at the end of the year. And during an up market, all my mutual funds were in the negative, all of them. And they were all in the negative because of the fees. And that's what sent me on a tangent, basically a self-induced project to really understand what the hell was going on behind the scenes. And therein lies why I finally ended up switching to Merrill Edge, which at the time had just stood up their self-directed investing program. And I guarantee I was one of the very first ones. I guarantee it. And here we are now, really, which is the root and it's the foundation of the independent investor channel. There's no doubt about it. And if I can get people started earlier in self-directed investing, then we're going to win the battle one investor at a time. And I've said that ever since the beginning. I think if you go back to video 1, I believe I talk about those very things because they're the root of the channel. I was nervous as hell. I'm still nervous when I shoot videos, but I had those core principles to hold on to when I started the channel, and I hold on to them now to this day. It's what drives the channel. It's absolutely my sole focus. And I think we've got a pretty good baseline started. I really do. I'm happy with the growth of the channel, but thank you for that question. That was really cool, man. Give you a little insight of where I come from, you know. And there's about a 7-year commercial fishing stint in there where I was actually learning how to kick my own butt out on the ocean. No doubt, learn how to work, you know. So it gives me a really interesting perspective, you know, on setting sail to the ocean, not really knowing what to expect, but knowing that if you work really, really hard, it'll pay off in the end. Does that sound familiar? That's the core of investing, no doubt. Also speaks to having realistic expectations when you invest in the stock market, you know, understanding what it is you can control and understanding what it is that you cannot control about the stock market. And not expecting more than what the stock market can deliver you. You have to be realistic. You have to, and it'll humble you, no doubt. But it'll also reward you. It will, and you just hope that the rewards are more than the disappointments. And I'm here to tell you that they are. But you can't be emotional about stock investing. You've got to be like a robot. Man, there's a ton of questions, guys. I just want to thank you guys again for all your cooperation on here. This is very, very cool. This is a hell of a discussion. Try to get to all your questions. Compounding of dividends is quite simple. Magic. Yeah, it is, you know, but I tell you, Scott, I want you guys to all understand that any financial planner will run you through the compounding calculator. That's really how they sell you on the prospect of investing, blah, 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 right? But compounding calculators are only applicable in a made-up scenario, okay? If you do not do a compounding calculator without taking into consideration the expense within that account, you are giving yourself a false validation for why you invest. Okay, you really are. And I agree with you. It is magic. I haven't done the rule of 72 for you guys, but the rule of 72 is really, really cool. I haven't memorized, right? For an anticipated rate of return of interest rate divided by 72, it'll basically give you the number of years that it will take for your investment to double, right? So if you take 8 and divide it by 72, I believe it's 9, right? Check me on my math. I'm not that great on it, but hold on. Hey, it's 9. Cool. I've got a calculator right here. So it should take 9 years for your investment capital to double with a rate of return of 8%. So if you take a 10% rate of return, right, that should take 7.2 years for your investment to double if you make a year-over-year return of 10%. So that's how the rule of 72 works, but it is magic, no doubt about it. It's awesome. But you guys need to pay attention to the fact before it starts to go parabolic at the end of the, compounding interest, your investments will go idle for a long, long time. And that's the time when you're sitting there and you're like, why am I an investor? Why the hell am I doing this? It's going down. What am I doing? What am I doing? What am I doing? What am I doing? And it comes back to that base that I alluded to earlier when you guys talked about, why you take and dividend reinvest. It's because you're trying to solidify that base as quickly as you can and start that parabolic approach, right, as you start to compound in your portfolio, right? So it's awesome question. Thank you for that. Where did you buy the bronze bull that sits on your desk? I want one of those. I bought it down on, it's right down on Broadway in Lower Manhattan. And they do sell them outside the New York Stock Exchange. I've been there twice. But this little guy, this cost me, this is $65, man. And I love this thing. Yeah, it's pretty awesome. It's been on the channel since the beginning. So I tell you what, man, if you, I would say, let's test out the new apps are Zelle and Venmo, right? If you want to fire, if you fired me over the money, I'd buy one for you. No doubt. This would be just as easy as eBay. But you'd have to trust me, send me your address, and I'd fire. I should really figure out how to fire it over to you guys. That's the big one. They do have a smaller version. If you see in Scribner's video, he's got one like this big. It's like a little baby bowl, you know. But those will run you, I don't know, $10, $15. But you do get them in Lower Manhattan. And the next time I go down there, I'm going to get the bear. Yes, I'm going to get the bear because it's kind of hard. You have to make a point to get down there and tote it out of Lower Manhattan. So I take the Staten Island ferry back over across where I live. I don't know. You shoot me over the money, man. I'll mail it to you. I won't charge you a dime. It's nope. I don't mind doing that, but they are cool. They are cool, and they come in different colors. The one that I really like better than mine is the one that's bronze, the one that's the actual color of the charging bull down on Broadway. So it's the only place you can buy them. You can't get them off Amazon. So yeah, we'll talk. We'll talk in the group. Hit me up, man. It's no big deal. So I'd be glad to do that. So are you into Forex? No, I'm not. I don't know the first thing about it. I'm sorry. Always leave cash on the side, waiting for the red. Very good advice. I'm a big believer of always having a cash cushion for sanity's sake, if nothing else. That's honestly, man, that's why I do it. Honestly, your investing capital should be your investing capital, and your sleep easy money should just be that. And you should always be looking to improve upon both of those aspects. And that's all they are. Just pieces of your overall financial health. That's all they are. Always looking to prove. I've been buying single stocks since the beginning. I plan on buying Procter & Gamble and Kimberly-Clark. I would pick one out of those two. They are similar, fantastic companies, no doubt about it. You'd be fine buying them both, dividend reinvesting or having them pay you the dividends. Faceless HD has been with me a long, long time. It's really cool how I remember some of these subscribers, man, because when I first started the channel, man, some of these folks would come on. Some of these cats are like legacy. You know, when the Independent Investor channel actually does get big, it's going to mean something to these plank owners, man. And every one of you guys means something to me, no doubt about it. And I appreciate every single one of y'all's involvement. And Faceless HD, man, you've been with me for a long time. And I think you'd be fine with both of those stocks, man. They're fantastic. Too many folks make their first investment a speculative stock. Yeah, GoPro. GoPro reported a good quarter, but certainly could probably rattle off about 250 investments that I'd rather own before GoPro, no doubt. And yeah, going after high growth, growth stocks. Look, single stock investing is aggressive. I'm sorry. But you invest in Johnson & Johnson, it's about as safe as a stock as you can buy, or an Apple. You're going to see haircuts in those stocks, man. And it may not be for good reason. And I don't want to see somebody, look at Kraft Heinz. I'm down 30% in Kraft Heinz. Aggressive. A single stock, right, is an aggressive form of investing. But the risk that you're willing to take on is reflective of the returns that you could get on it for the future if you're willing to take those positions in those stocks. Can I kind of get into the end here, guys? I go as long as I can, and this is about the fastest hour every Friday. I look forward to this. I'm going to do it all the way up until I move. We're going to be moving in a couple months down to Virginia, and that's where I will be picking up the Independent Investor channel. I've already done my goodbye video for New York. I did it quite some time ago, and I will post that. It will be my last video that I post from New York. In the meantime, we are going to continue to hold true, and I'm going to continue to deliver the message for you guys. Yeah, my bare feet, man, that's a standing joke. I do that for a reason. You got to fight the power, man. You got to fight the power. That's all there is to it. I do it to prove a point. But thank you to everyone who contributed to the group tonight, man. I really think we've got a pretty awesome thing going with this group. I appreciate the dialogue. I appreciate Dave coming on again. I always try to give those shout outs to the channel creators. Thank you to Dave. He was helpful as well on the discussion. I'm kind of scrolling through here, guys. The tail end of this discussion I kind of missed. Thank you, Ryan. You're welcome. I've got some emojis that look like they're happy, so I guess we got to a good place. VDE is a nice, cheap way to get energy exposure as well. Yeah, I've got the Vanguard ETF list pulled up just for reference here. That could be a good way to actually play that particular sector. Yeah, one of the group is from Canada. I get hit from people all over the world, actually. A lot of people can't watch this live feed because it's 9 o'clock Eastern Standard, and I've got a lot of people who appreciate me posting it after the fact. That I will post it again for all those folks. I was making Oreos at 16. Nice. When it comes to money, you've educated yourself. Yeah, I have. I've rested on a lot of what I've got from the financial planners as well. I really have. And I do give credit where credit is due. But certainly, that's only half of the story. I think what is, most telling in the financial industry is what you don't know. And that is the prospects of investing on your own. And a lot of people underestimate the power of those two aspects. They'll start a Roth IRA, right? And underestimate starting a self-directed Roth IRA. So you're taking a tax protected account only to subject them to all the fees of the financial institutions, right? And that'll restrict that otherwise tax protected and wealth preserved account going forward. And it's a cardinal sin as far as I'm concerned. It really, really is. You've got an amazing channel here, Ryan. Have a great evening. Look forward to Friday. Hey, thank you, Doug. Very cool. Thank you for your time. I think it's an hour well spent for you guys. We can get on with our evening. I'm going to relax. It's been a long day for me, actually. I wasn't kidding about the air conditioner joke at the beginning of the script. I lost it in my car and my apartment. So I had to sleep in 95-degree weather, actually, at some point this week and still go to work the next day. But we got that thing fixed, man. Do you have any advice for dividend investor only? Yeah, I do. I just want to make sure that you're following the right order of investing. There's so much that you can do to prepare, right, in way of debt reduction, budgeting, getting your cash savings started up, starting your passive investment. Hell, start the account first. There's so many people who and I'm talking to Alan West right now. There's so many people excited about investing that don't ever take that first step in starting the account. Start the account. Start it. That's it. And then allow yourself to scale into the stock market. Allow yourself to transition from a non-investor to an investor. And I talk about starting a baseline first. Start a baseline for yourself. I can go into in-depth as to why you do that, but it's going to make sense to you in the future, right? Because if you just start jumping into single stock, investing in single stock, you jump into 6 single stocks and none of them go up, but the rest of the market goes up, you're going to get frustrated because you're not participating in that upswing of momentum. You've picked the wrong stocks. You've zigged while the market has zagged. And a lot of people fall victim to this. So make sure that your order of precedence is correct. And I think that's the soundest advice that I can give you. There's so much you can do free of charge to prepare yourself to enter into the stock market. And once you get that fundamental base, then you can start adding those cornerstones in the portfolio in way of those good dividend payers, right? Johnson & Johnson, Procter & Gamble, Kraft Heinz Food, Apple Computers, JP Morgan Chase, Wells Fargo, 3M, right? Then you can Caterpillar, you can start to add some of those pieces to that portfolio, man. But when I talk about building a portfolio, it is just that. It is building, right? And you've got to approach it like that. You're not going to build a portfolio overnight. So thank you for that question, Alan. Very, 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 very good. Can I help you today? Yeah, I need 38 bulls. Oh God, I'm going to stick my bare foot in my mouth on that one, man. That's, but hey, whatever. I can do whatever. regarding the bull, I'll consider it. Thanks a bunch. Definitely need the bear as well. I need to get back out to NY for a visit. Oh, you hit me up, man. No doubt. We go downtown almost every weekend, man. That's where I shoot my footage from. Maybe this can be an excuse. Definitely. I told you right where they're sold from. And I think they sell it during the summer. During the winter, when tourists aren't really coming to New York City too much, all us locals are here. They really do. They tend to pull it out more in the spring and the summertime when they get a lot of visitors to New York, man. But however you want, man, that is cool. Thank you for hitting me up with that. That's pretty cool. I like it. It's one of my one of my staples of the channel. That's all. Just a piece of decor, man, that kind of speaks to how I approach the stock market, because I'm really aggressive, on free market and the stock market actually continuing to go up over time as it's done historically, right? So, hey, I want that raging bull. Oh, God. I'll probably it'd be kind of funny to open up my account tomorrow and see like $10,000 in my Zelle account. That'd be funny. I'd be like, holy crap, I got to go to Lower Manhattan and buy like 65 bulls for my group here. But hey, I'm from Virginia. Welcome. Hey, thank you. Thank you very much. I hear it's very nice down there. Looking at Virginia Beach. That's where we're looking. So either Virginia Beach or Chesapeake. So from New Jersey. Yep, you're my neighbor right now. Thanks for the live feed. First time joining on Friday. Fun stuff. Cheers. Thank you, Scott. Appreciate it, man. Dang it, I'm late again. No worries, Isaiah. I'm going to go ahead and put this online for future review. You can skip around as you see fit. I thought, again, I'm actually improving. I enjoy these. This is a little bit more in my wheelhouse. That's the coolest emoji that I've ever seen. Nyella owns it for the coolest emoji that I've ever seen right there. You take the cake right there. Always great. Thank you, NYC. We'll miss you. Thank you so much, everybody. I appreciate. I'm going to go ahead and sign off right now, guys. And like I say, always thank you for tuning in. The channel rests with you guys. It really does. I answered this question this week, and I mean it. The success on the channel is based on you guys taking this information and using it. Use it aggressively. Take it and use it to enrich your own lives. And that's where the success of the channel lies, guys. And as I say always, good luck in your investment future. I will see you guys next Friday. Thank you very much.